When was the last time you thought, I wish I could pay more in taxes? Exactly. Never. We're here to help you save on your tax bill. And I'm curious how you feel taxes are headed. Most people do not think taxes are going down. They think taxes are going up, perhaps staying the same because you've seen some of the political headlines on where things are at. That perhaps with the Republicans sweeping the federal government, perhaps taxes don't go up in 2026. Perhaps they stay the same. That's why we like the idea of planning as opposed to a plan. You create some plan a few years ago and say, here's what I'm going to do for the rest of my life. And things change. The market changes, the politics change, all kinds of things change. That's why you've got to focus on the planning as you are going about retirement. And you might be wondering why I held up a 100 grand bar earlier because, well, it's my favorite candy bar to begin with. Love chocolate and caramel myself. So now you know what to get me for Christmas. But when you're looking at your retirement, you're making decisions that cost you or make you 100 grand or more. And all these decisions have to do with your timing. When do you get things done and your tactics? What are you doing with your investments? And these tactics, it's amazing. You have a lot more opportunities, a lot more flexibility in retirement. So I'm going to show you a few examples. These are two clients I met just a few years ago where they got the timing right, and one of them got the timing wrong, and another one was looking at the wrong tactic, and we were able to help them switch to a different tactic. It worked out pretty well for them overall here. So we first met Sally, who was looking at doing a Roth conversion, taking traditional IRA money, switching it over to a Roth, paying taxes on the meantime. We had taken a look at it. She had a really high income that year, a low income the next year. And we said, you want to do a $200,000 Roth conversion. That was the number that made sense for her. But you ought to do that, Sally, in January. Wait till January because you'll be in a lower tax bill, lower tax situation. The timing is a big key difference. Well, I call her up in January and she said, I just couldn't wait. I just took care of it in December. And I'm sure it wouldn't matter much at all. Well, it was too late. It's already past the tax year. She couldn't have changed anything. It was interesting because she had paid me for my advice the prior year. And it said, this is a great idea. Here's the right dollar amount. Do it in January. It's going to work out really good for you. But she would have had done it in December thinking it's not going to matter much at all. I didn't want to tell her how far off she was, but I knew it was a big number. I calculated that number of what happened when she was already in that high tax bill, tax bracket, and she went higher compared to if she waited another year. The difference was $23,000 more in taxes because she got the timing wrong. She did it mid-December instead of early January. 3-week difference, $23,000 more in taxes for her. It was amazing and unfortunate, really, because you think it doesn't matter. It matters. The timing of when you do things matters a lot with retirement planning and your taxes in retirement. Meanwhile, we met Harry around the same time. He was looking to retire. He was going to need $100,000 of income, and his tactic, his plan was, let's do a 401k withdrawal. Makes a lot of sense, right? You're working, you're adding money into the 401k. You stop working, you take money out of the 401k. Well, we took a look at it. He had a bunch of money in regular stocks, regular brokerage account. He needed that $100,000 of income. I said, you know what? With your situation, let's put that money in your checking account by selling stock, right? You could sell stock out of your 401k and take a withdrawal, or you could sell stock inside of this thing called a brokerage account, not an IRA, anything like that. And of course, I run the numbers every time to see how does these two different tactics work. And doing the stock sale was $9,000 less in taxes. So you've got Sally, who got the timing wrong, unfortunately. You've got Harry, who we were able to switch around the tactics and lower his tax bill that year by $9,000. It's just amazing the differences and the flexibility you have in retirement on the timing and tactics. As you're going through and planning for retirement, that's my encouragement to you, is to decide what's your best timing, what's your best tactics overall. I'm guessing as you're going through retirement, you would rather not be a sad Sally. You'd rather be a happy Harry. And that's why you're here learning about the retirement planning pieces, the taxes that affect you in retirement. Here's a bit of the roadmap for today. I'm going to tell you first why I'm here and why I focus on retirement planning, why my team focuses on retirement planning, why I really care about you saving or making 100 grand or more. I'm going to share with you the number one mistake that I see retirees make so that hopefully you can avoid that mistake. Show you a few strategies that'll help you avoid those mistakes, lower your lifetime tax bill. And I'm going to encourage you to take some action so you can learn how to get started. Actually, take control of your retirement planning and lower that retirement tax bill. Now, here's a bit about myself, and you might not have seen me speak before. I see a few familiar names out there, but let me tell you why I became a financial advisor, why my team focuses exclusively on helping you make great retirement decisions. And I know this might sound a little geeky, but when I was growing up, I loved playing with numbers, solving different puzzles. It's like those math logic puzzles. Here's an example on that. You might remember that from back in the day from grade school. It's stuff like Sally's taller than Billy. Fred is standing next to a girl. You're just trying to figure out like who's which name and what position they are in line. I've got a fourth grader now, and she's bringing these home for her math homework, and I love doing them. So I've got to like hold back, help make sure she's actually doing it. I just want to jump in there, do it myself. I love doing these math logic puzzles. But then I graduated college, and as I got older, my Aunt Barb said, "You know what? You're good at math, and you love helping people. You should be a financial advisor." It turned out she was right. From day one as a financial advisor 22 years ago, I just fell in love with it. I was able to take my kind of childhood love of puzzles and just apply it to the real world, except that the payoff had nothing to do with a good grade or solving a puzzle. The payoff had to do with my clients getting 100 grand or more in extra Social Security or saving on taxes. It's why I get so excited when I'm helping my clients create their retirement plans. But it's not just about making or saving you hundreds of thousands of dollars. It's the fact that you only get one shot at retirement. You only get one shot to get it right. And unlike a normal puzzle, you don't get do-overs. You don't get to try it again. When you retire, you're making decisions on your 401k, your Social Security, your pension, decisions that affect the rest of your life, decisions you never faced before, you've never been trained how to do it. And if you're in a couple, if there's two of you, these decisions that you're making as a couple most often affect that 90-year-old widow, but they're made 30 years earlier by the now deceased husband, right? You're making these decisions, you can't ever change it. And I want to make sure you're making decisions that both help you now and help out that widow down the road. Now, here's what I find with investors. They're making their number one investment mistake. When I'm on my first Zoom call with you, when you're in my conference room for the first time, usually they're sharing with me that they want to pay less in taxes. They want to get more income. They want to avoid big retirement mistakes, but they are focusing on things that I think they should not be focusing on. What they're focusing on, the number one investment mistake they're making as a retiree, is they're trying to control things they can't control. That's the mistake that I see people making time and time again. You're trying to control the stock market. You're trying to control politics, inflation, the interest rates. You can't control the Fed and interest rate. You can't control things you can't control. But there's a lot of things you can control in retirement. You have a lot more flexibility in retirement with your taxes and a whole lot of other areas than you did before. You can control ahead of time how much you save for retirement. You can control when you file for Social Security. You can control how you take your pension. Is it a lump sum? Is it monthly? What's the survivorship option for your spouse if you're married? You can control the timing of when you take money out of your accounts, right? You can take money out in December or January, like Sad Sally. She chose to take it in January, paid 23 grand more in taxes. Oh, sorry. I told her to take it in January. She chose to take it in December. That cost her 23 grand in taxes. This timing is a big thing you get control over. And your withdrawal account. That's what happened for Harry. He took the money out of the brokerage account as opposed to the 401k. That helped him out at all the time, right? You've got traditional accounts, Roth accounts, brokerage accounts, savings account. That's 4 different types of accounts, 4 different tax situations. I'd encourage you to focus on these things that you can take control. When you take control of the things you can control, you often make extra money from your Social Security, from your pension. You often save on taxes because you plan it out. You took a look and saw when are taxes expect to be lower, and that's when you paid your taxes. And you avoided, you deferred, you made sure taxes didn't show up in those years when your rates are expected to be high. Now, we work with a lot of folks that have $500,000 or more. The reason being is that the tactics I'm talking about today, it seems like that's a crossover point. When you have less than 500,000, these ideas around tax savings, especially, don't seem to build up enough tax savings. When you have above 500,000, we often see that's that 100,000 or more in tax savings that we see because you've got that ability with enough money, especially in traditional IRA type accounts, to make some decisions on the timing, on the tactics to lower your lifetime tax bill by 100 grand or more. If you have less than $500,000, I want to make sure you're doing the best with your retirement too. Here's a few ideas, and here's what I'm talking about where why we focus on folks with more than 500,000, how that tax savings really helps you out when you're in that situation here. Now, I took an individual, or a couple rather, started them out at 250,000 in our tax planning and retirement planning software. And I did 2 different things. I said, what if they do some Social Security planning? What if they do some tax planning? Really, there's 3 big levers you can pull to get more income in retirement, right? You can choose when you retire, you can take advantage of taxes, and you can decide when to file for Social Security. So with this individual, this couple, I asked one of them, just wait 5 years on filing for Social Security. Not both of you. Somebody took it at 62, but one person, the person with the higher benefit, I said, what if they wait 5 years? That's a common tactic we suggest. Just wait maybe 3 years, 5 years. How does that help you out? The expectation is that 5 years of waiting on Social Security boosted the amount of money you had available to you over your lifetime by $85,000. Right? Didn't do anything fancy besides just waiting on Social Security. Then I tried to do some fancy things with planning out some taxes, and the tax costs of their entire lifetime, when they started with 250,000 of investments, that tax cost is virtually the same. And so we see that when you have less than $500,000, oftentimes the 2 biggest things you can do is to wait on when you retire. That helps boost your retirement income, and to wait when you take your Social Security. That also boosts your retirement income. The tax planning, look into it, but often we don't see the big savings on taxes when you have less than $500,000, especially in traditional IRAs. Now, what happens if you start out with $1 million, right? If you start with $1 million, you've got that same ability to plan out your Social Security, and now we see the tax planning really just starts kicking in, right? So we've got somebody that did tax planning and Social Security planning. We saw 300,000 boost. A few more of these. I need to get some more 100 gram bars. I probably ate a couple of them in the last couple of weeks, right? So 300 gram bars of retirement benefits because they waited on Social Security and they did some advanced tax planning that we're talking about. Now, the biggest majority is still from Social Security, right? We saw 200 grand extra benefits towards their retirement because one of them, not both of them, just one of them waited 5 years to file for Social Security, but there's still 100 grand from their tax planning decisions. And even if you've got that $1 million, a lot of times people think, what does it matter with Social Security? It all evens out. I still saw when you have $1 million that your Social Security decisions have a huge impact to your retirement. So we're often looking at Social Security decisions, tax planning decisions. When you have over $500,000 or more, we often see that 100 grand or more in tax savings. Now, if that's you that has over $500,000 or more, and you want to learn how to discover how much available benefit you might have, I'm going to launch a button. Go ahead and click that button so you see really how this looks for you. So go ahead and click that button. When you click that button, you're going to see a web page that says Tax Smart Visit. I've set aside 30 minutes on my calendar or my other advisor, John, his calendar, where you can ask us any questions you have, and we'll take a look with you. Just ask a few bits of info around traditional IRA accounts, Roth IRA accounts, things like that with Social Security. And we can show you a number that we think is available to you, make a few different decisions, and here's how much you might get from extra Social Security. Here's how much you might save from your tax planning decisions over your lifetime. Imagine what you could do with 100 grand or more. Imagine the extra vacations you could take. Imagine the money you could give to your kids while you're living, or maybe your grandkids for college education. So go ahead, click that button, see how the calendar situation works. Go ahead, book that Tax Smart visit. All right, so I'm going to go through some retirement tax savings strategies, but all these strategies are based in kind of some different principles, different beliefs here. The first is that your taxes are likely to go up. I also believe that doing nothing might hurt you, and I believe that you can control your lifetime tax bill. I said earlier that tax and Social Security decisions, they fit together kind of like a puzzle. You're here to learn about taxes in retirement, but taxes are just part of retirement. When you're solving that retirement puzzle, it's good to see what all the pieces are to fit them together so that you can make those better decisions. So what we've done is we've put together a retirement income strategy. I call it your 5-step retirement master plan. And if you do these strategies in this order, I found over the past 20 plus years of working with people transitioning to retirement, it really helps them retire with more confidence, really helps them make great decisions about their pensions and Social Security, their investments, their tax planning. So this is the process I use. I'm going to walk you through it. You can write this down. You can use it on your own, right? Or you can have a familiarity of how we approach things, both myself and my advisors on my team. So you're going to team. You've probably noticed John saying hi, answering questions in the chat. So John's just going to introduce himself right now in the chat, and you'll just get an idea of who's helping you guide you through this process. Well, the first step, you got to have a first step in a 5-step process. The first step is figuring out how much are you going to spend in retirement. It's a matter of how much do you need, and it's also when you need it. I'll give you 2 quick tips. If you're trying to figure out how much do I need in retirement, the first place to look is your checkbook. When you go to work and your take-home pay shows up in your checkbook, usually that's what gets spent, right? Whatever shows up in your checkbook usually goes out. So if you're wondering how much I'm going to spend in retirement, take a look at your checkbook. You don't have to do a big budget. Just take a look how much shows up every 2 weeks into my take-home pay and my checkbook. If you have 4,000 every 2 weeks showing up in your checkbook, that's times 26 paychecks. That's 100 grand, $104,000 a year. That's probably what you're spending. And if you hit retirement, chances are you're going to spend as much as you're spending now. You might spend more because you got more time to actually go about the spending. So the first step, if you're trying to figure out how much do I need in retirement, is take a look at your take-home pay, and that's just showing up in your checkbook. Go take a look, see how much is showing up consistently for you. That's what you're trying to do. You'd love to retire, get all that income without actually having to go to work because you're getting it from other places. Now, here's a tip for when you're deciding when you might retire. If you ask a 55-year-old, when do you think you'll retire? They'll tell you 65. But if you ask a 65-year-old, when did you retire? They'll tell you 62. On average, you retire 3 years earlier than you would expect. So as you're doing your spreadsheet, as you're planning, as you're talking to your financial advisor, go ahead and say, yeah, I plan to retire at 60. I plan to retire at 65, 67, whatever the number is. But be prepared for it 3 years ahead of time, because on average, you'll retire 3 years ahead of time. That's my tip there for the first step. Figuring out how much do you need and when do you need it. The second part of it is figuring out how to max out your monthly lifetime income. Just because you stop working doesn't mean you stop making money. You still make money in retirement from Social Security. Maybe there's 2 of you. Well, there's 2 Social Securities. You might still have a pension from way back when. You might have bought some sort of annuity a few years ago that's guaranteeing you an income. You might have some real estate investments. There's things here that are paying you out a monthly income, and especially your decisions on Social Security, your decisions on pension, getting that right at the start is incredibly important for the rest of your retirement, because you don't get any redos, right? You don't get redos with your pension and your Social Security. So you better get that right on the start, which is why we say, yeah, right away, we got to look at this info and help you make decisions on your pension and Social Security before you even look at your investment situation, before you even look at your tax situation. Those are important, but it's just the proper timing of it. So number one, figure out how much you might spend. When do you need it? Number two, try to maximize your monthly lifetime income. Once you maximize your monthly lifetime income, let's try to help you keep more of that money by lowering your lifetime tax bill. My encouragement is for you to take a look this year at your taxes. Uh, take a look at last year's tax return, project out this year's taxes, project out all your future taxes. When you do that, you quite often see that your tax rates go up and down. Things happen differently over time. Like before you retire, after you retire, before you turn on Social Security, after you turn on Social Security, with required minimum distributions before and after, things like that. When you project out your lifetime tax situation, you'll see times when they're likely a higher tax bill, times when it's likely a lower tax bill. What you want to do is put taxable income into the years with a lower tax situation. That's how you end up smoothing out, how you end up lowering your lifetime taxes. You find, oh, hey, here's a lower tax year for whatever reason. Maybe you retire, but you haven't turned on Social Security yet. Let's try to maybe put some income into that year, pay the lower tax rate. And you might see that my last year of working, I get all these bonuses and my PTO pays out and things like that. You have a higher income. You want to find ways to defer, to wait on that income so that later on. So if you project out your lifetime tax situation, you can take control of your lifetime tax situation. The next step is investing. And when you're planning for retirement, everyone tells you save for retirement, invest for the future, invest for the long run, leave the money invested when the market's down. And that's right on if you are investing for the long run, but your retirement, now you have a short run. You need money today. And my best encouragement to you is to use what's called a bucket strategy, where you've got money set aside, short-term interest rate investments for when you need it in the short term, long-term growth investments to keep on growing. A lot of people think I hit retirement, I don't need any long-term anymore. You hit retirement at 60, one of you, if there's two of you in the couple, might be living to 90. That's still a long amount of time. You still need some long-run growth investments. You just need to have some short-run, short-term type investments too. You can't leave your money invested for a long run if you don't have money available to you in the short term, which is why we encourage you to split that up, kind of bucket it into short-term and long-term money. The fifth step is saying, what do you leave behind? You might leave behind some money. Sometimes you leave behind some bills to your family. There are different risks to your retirement. There's different things that happen if you die too soon. There's different things that happen if you live a long life, right? The longer you live, the worse your health situation gets, which means the more your healthcare costs turn into. And planning that out, seeing what might happen ahead of time is the way to go about doing that. Now, when we took that poll earlier, just about everyone said taxes are likely going up. It might be because you've realized, okay, taxes are actually at a low point. Here's all the tax situations. This is the top marginal tax rate since World War II. You notice the last 20, 30, 40 years, the taxes are actually fairly low compared to before. So one reason you might think that taxes are going up is they're rather low. Another reason might be because the national debt is just keep on growing. And a lot of people say, oh my goodness, the government owes a bunch of money, taxes are low, they got nowhere else to go. Taxes seem like they have to go up because how else are we going to pay for this debt that's out there for the U.S. government? Another reason why people say that taxes are going up is, well, that's the law. In 2024, the tax rates are lower. In 2026, the law says it's going up by 3 or 4 percentage points. Now, 3 or 4 percentage points doesn't sound like terribly too much, but if you look at especially the 12% rate that's headed to the 15% rate, well, 3 divided by 12, that's 25%. The tax rate in that bracket, which is a lot of people, that's basically if you make between like 40 to 120 or so, if you're married couple if you're filing joint. So maybe like 20 to 60 or so if you're single. That's a lot of people in the country. That tax rate's going up by 25 percentage points. That's a huge difference. That amount you pay in taxes might be going up by then 25%. Now, of course, the Republicans back in November kind of swept the federal government. So maybe these taxes stay the same. Maybe they don't go up exactly on January 1, 2026. But that's the law right now. They actually have to go pass a law to make this happen if the tax rates happen to stay the same. We'll see. That's why you've got to plan things out. You don't want to go to extremes generally because things can change. I started as a financial advisor in 2003. All I heard for the first 15 years of being a financial advisor is taxes have to go up. That's the only way they're going to go. And what happened in the year 15 of being a financial advisor? In 2018, the taxes went down, right? So just because you think that the taxes are staying the same with the Republicans winning, just because you see the tax laws in place that the taxes are going up, doesn't mean it's going to happen. You've got to be ready for, kind of flexible for whatever might happen for you overall. Now, I feel that whether your tax rates go up or not, your tax situation will change over time. Your taxes will change when your life changes. And when you plan things out, you want to see these kind of before and afters of what's my tax situation before this transition, what's my tax situation after, even without doing the fancy tax planning, the 30-year projections that we do with our clients. Just kind of thinking this before and after these 4 areas will really help you out in your planning. Think about what's my tax situation before retirement and after retirement. What's my tax situation before and after starting Social Security? The taxes on Social Security, I'll show you that later on, are just nuts. And to where the taxes you pay, the rate you pay, might just be double what your tax bracket is. We'll show you that in just a bit. Think about before and after when you start to require minimum distributions. Your tax situation is likely to change there. And if you start into retirement as a couple, the one thing you don't want to think about, but is very much a reality, and no one I've seen to meet plans for this until we help them plan for it, is what happens then if you file as a single individual. When you come in as a joint couple, your tax rates, your tax brackets will shrink in half when the first person dies. That widow, oftentimes it's the widow, right? Their tax brackets get cut in half. It takes them maybe 60,000 to cut to the next tax bracket as opposed to 120. If your tax brackets get cut in half, it's easy for you to get into the higher tax bracket. And so we quite often see that when there's 2 of you, the tax situation isn't too bad, gets down to 1 person, and the tax rates often skyrocket on there. So you want to plan that out ahead of time. Most people I talk to every day, they think that taxes are going up, but they haven't, unfortunately, made a plan to get ahead of those changes. So here's the 3 steps I'd encourage you to take. Here's the 3 steps you can take to get ahead of, hopefully lower your taxes in the long run. Step 1 is to review your tax return, right? See what happened last year. That will help you do step 2, which is projecting out when things will change. Now, you might use the fancy tax planning software that we use to do like a 30-year projection and find those spots of high tax rates, low tax rates, or do what I just said earlier, where I do the kind of before and afters, these life transitions on there. When you do that, when you project things out, you can take control. And when you take control, you can lower your lifetime tax bill. Unfortunately, very few people I see do this, whether they do it on their own or do it with a financial advisor. I'm going to ask you a question here. I'm going to do a poll. This poll is, does your financial advisor review your tax return every single year? I'm curious what your tax advisors, your financial advisors rather, are doing every year. Virtually everyone says, no, my financial advisor is not reviewing my tax return every year. Sometimes people say, well, why would they? Right? That's why I put that in there. Why would they bother? Every financial decision you make gets reflected into your tax return. If you decide to take money from your traditional account or your Roth account or your regular brokerage account, if you decide to do a Roth conversion, if you decide to file for Social Security, if you decide to use the Affordable Care Act, these all get reflected into your tax return. I can't imagine how anyone can call themselves a financial advisor without reviewing your tax return, because every bit of advice they're supposedly giving will get reflected in your tax return. You need to see, okay, did all my advice last year pan out the way I wanted? And you need to see, how did last year work? So let's project out what the next year might look like. That's my encouragement. If your financial advisor is not asking you for your tax return, I would just question that word advisor to begin with. You've got to see the results, and you've got to project out what is happening in the future. Now, I said earlier that doing nothing might hurt you, and that's interesting. Most people end up doing nothing with their tax situation. We ask them, when do you want to pay taxes? Do you rather pay taxes when they're lower or higher? Well, yeah, I want to pay taxes when I'm lower, right? When do you think taxes are going to be higher? Well, it's later on, right? Later on, taxes are expected to be higher. So I ask them, why are you waiting until taxes go up to pay your tax bill? You can take control and pay your tax bill early. That's something called a Roth conversion. We'll talk about that in just a second. Now, I'm not making this up. This is from a study that TIAA did. They've got millions of retirement accounts, and they found that the average person retires today and waits 4 years until they take money from their retirement accounts. That's 4 years that they could have been planning out and paying taxes on purpose. Just over 50%. Half of retirees fully wait until required minimum distribution age before they start taking money out of their traditional IRA. What they're basically saying is taxes are going up in the future. The government's in charge of the tax rates. The government's in charge of the required minimum distribution rules. I'm just going to go with the government program. Let me just wait till the future and just take out what I'm supposed to do and pay whatever the taxes are at the time. I would love for you to look at things ahead of time, take control over your lifetime taxes. I often see that you save on those taxes. I often see that tax savings projected at 100 grand or more in lifetime taxes. We know that most retirement money is taxed. We expect that taxes are going up. So my question to you, my question to your advisor is, why are you waiting to pay taxes until you have more money in your accounts at a higher tax rate? I believe you deserve to pay the lowest taxes you can legally. And most people think it's going to be a big problem in retirement. Most people aren't doing anything about it. If you'd like to do something about it, go ahead, click that free Tax Smart Visit button. Get onto our calendar to have us answer those questions about how you can save money on your tax bill, how you can get more out of your Social Security. It's often 100 grand or more extra from Social Security, often 100 grand or more of tax savings that we see when you've got over $500,000 or more money you get to put towards your vacations, towards your family, towards your kids, your grandkids' college. So go ahead, click that button, book your Tax Smart visit. I believe you can control your lifetime tax bill. You have a lot more control in retirement than before retirement. Before retirement, you went to work, you got your W-2, you gave it to your tax preparer, and you just hope for the best. But when you hit retirement, you get all these choices. You get to choose when you file for Social Security. That's a big difference on your taxes. You get to choose when you take money out of your accounts. December versus January it's 2 different tax years. It could be a huge difference overall. You get to choose which accounts you take money from. Is it the traditional, the Roth, the non-IRA, the savings accounts? These are 4 different accounts, 4 different tax consequences. You can run your tax projections. Okay, I need 10 grand out. Which of these 4 accounts, what's the tax bill on taking out of these 4 accounts overall? When you choose how to file for Social Security, most people think, I wait on Social Security so I can get a higher amount of Social Security. That's true. It's especially true when it's the higher of the 2 Social Security benefits that are out there for you, if there's you and a couple. But it's also true that waiting on Social Security is 1 extra year you can do Roth conversions. Most people are ignoring this Social Security tax decision. You wait 1 year on Social Security, it might just give you another year for Roth conversions. I've got a few people right now they're coming do their birthdays in like August, July and August coming up here next year, and they want to file on their birthday, which is good for them in their planning. But they're it's halfway through the year, and when we looked at it, we said, why don't you just wait 6 months? If you wait 6 months till January 2026, not only do you get 4% more because you waited over 6 months, 4% more of your lifetime. That's nice, but it got you to have the entire year of 2025 as no Social Security. That just gave them an extra ability to do more Roth conversions. If you look at just the idea of tax planning through Roth conversions, the idea of waiting on Social Security, it's like the combination of those two often gives you more benefit than just the individual benefits on their own. You get to choose when you take money out of your account. So we saw with the TIAA study, most people wait until required minimum distribution age. Just because you don't need the money doesn't mean you can't pay taxes on the money. The way you do that is something called the Roth conversion. That's interesting with the Roth conversion. When I tell people they can do a Roth conversion, I hear a couple different things. One thing I hear is, well, I retired, I can't do a Roth contribution anymore. Yes, but you use the word contribution. I'm talking about conversion. They sound so similar. It's like the same word, basically. The contribution is I'm putting money in the account because I went out and had a job and got some W-2, some wage income. True, if you don't have the wage income, you can't contribute into the account, but you can always convert. You can take money from your traditional account over to your Roth account. And if you find that's a good idea because you did tax projections, you can do that anytime you want. Doesn't matter if you're retired, not retired. So the next question is, well, that's just too much taxes because I've got $1 million in my traditional 401k. If I just convert the whole thing, that's way too much taxes. I should never do that. And you're probably right. Converting like $1 million from traditional Roth probably is too much, but no one said you had to convert the entire account. A lot of times you feel like this conversion is based on the account. The conversion is based on the exact dollar amount down to the penny. You can convert 1 penny over if you want from your traditional to your Roth. And when you plan ahead, you can decide exactly how much you want to do as a Roth conversion and exactly when you want to do that Roth conversion. And quite often, whether you're doing the conversion, whether you're taking money out of your accounts, this 2 times tax year is a big deal. You can take money out in December and use it in January. You can maybe have a line of credit or your credit card. You can spend money in December and then take it out of your accounts in January to just pay that off, right? You can easily take a look and just split apart your tax timing of it, especially when you get towards the end of the year. A lot of times people take out money towards the end of the year for tax bills, property tax, vacations, Christmas, things like that. Really pay attention. How does this affect me if I take the money as taxable this year or taxable next year? You have so much more control in retirement than you do before retirement. We talked through all those, the different controls that you have, where you've got more control over which account you take money from, right? You're past 59 and a half, you can take money out of your traditional IRAs. You're past 55, you can take money out of your traditional 401ks if you've left employment from that job. You can take money out of Roth. That's tax-free. We've had people take money out of the Roth this past year, tax-free, because we didn't want to affect their tax situation. We've had people take money out of their non-IRA accounts. You need 20 grand. Well, you bought the stock way back when for 10, it's worth 20. Well, sell the stock, take the 20 grand. It's only the gain that shows up in your tax form. And if you waited 12 months and a day, if it's in the long-term tax category, it's a better tax savings for you compared to taking it from a traditional IRA or 401k. And of course, take money from your savings account. There's no taxes on that at all. Before you control your lifetime tax bill, you've got to project it out. And when you project it out, you often see that your tax bracket might actually be your tax rate. I'll show you how that works and why we use something called a tax map. This is something can show to you how your tax map works. You project out your taxes, discover that your tax bracket might actually be the tax rate that you're paying on, and you want to pay taxes when they're low, right? Think of what happens when you aren't on Social Security or you're on Social Security. Or I've had folks with $5,000, $20,000 in Affordable Care Act premium tax credits. You've got to plan for that. You've got to plan for what happens when you're on Medicare. When you're on Medicare, if your income is too high, you pay extra in Medicare. We're members of the Wisconsin Institute of CPAs. I talk to tax preparers all the time, and those two areas I tell you, they're missing it all the time, where they tell the client, you probably asked them what tax bracket I'm in. They'll say you're in the 12% tax bracket, the 22% tax bracket. You got to dive one step further and say, well, how does this affect my premium tax credits with Affordable Care Act? How does it affect my Medicare? Do I pay extra Medicare? Do I lose Affordable Care Act tax credits? And with Social Security, it's what's my marginal tax rate? It's really goofy with Social Security. I don't think they meant to do this on purpose, but it's the way it works, where you might not pay that much in Social Security taxes, but as you add income, more of your Social Security goes from no taxable to higher taxable. You can't really, it's hard to explain, which is why we use something called a tax map, a visual of how this works. Now, this is something I see quite often, especially when you're either a single taxpayer in retirement, and oftentimes you get to there because you're a widow, where you might be at a 0% tax bracket. If this is you in a 0% tax bracket, I'm seeing here 10 grand a room. Go ahead, pay taxes if you can on $10,000 of income, because you're paying a 0% tax bracket, tax cost. If you don't look at it, if you don't plan it out with a tax map, how do you know there's room there for you to pay taxes at 10%, 10,000 in this case, at 0%? Then you see the blue area is what's your tax bracket. And that makes a lot of sense. If you grab 10 grand out of your traditional IRA, your traditional 401k, your tax bracket, there's your tax rate. But when you have Social Security show up, where you took out 10,000, but now 5,000 or 8,500 of your Social Security went from tax-free to taxable, you might have taken out $10,000, but now you have 18,500 show up on your tax return. If you're in the 12% tax rate, right, that's about 2,200 that you pay in taxes. You're in the 12% tax rate. You took out 10 grand, but you have 2,200 of taxes. That's a 22% tax cost. It's because of just the way that Social Security interacts with your other income. Or sometimes you're in the 22% tax bracket, and the way that interacts, you take out 10,000, but then you're not paying taxes on the 10,000. You're paying taxes on 10,000 of income plus 8,500 Social Security. The tax cost there is $4,100. You took out 10 grand. You paid 4,100 of taxes. That's a 41% tax cost for that decision. Or I love our tax map how we've got these dotted lines where if you hop over these lines, that's an extra cost to you on Medicare. What's sneaky about that is something you do something today. It's not till 2 years later on that you're paying $1,000 extra per person for Medicare, $2,400 extra per person for Medicare. When you're making tax decisions, when your financial advisor is giving you financial advice about your investments, you've got to take a look at your tax map of what's going to happen today, what's going to happen down the road that you're projecting out to help you make good decisions. When you're looking at your retirement planning, if you want to pay less in taxes, if you want to take control of your retirement, if you want to go ahead and take action, go ahead right now. Click here to schedule a time frame that'll give you 30 minutes on my calendar or my associate John's calendar for you to go ahead and learn how you can take control over your tax bill. That way you can take that 100 grand of tax savings. Don't give it to the government. Go ahead, take that 100 grand tax savings, put it in your own pocket. Enjoy your day.